So let's start. What's this club about? Finding great businesses. And I don't know if you've read the book, but it's worth reading. Go through the book, and it's trying to find these businesses when you realize what the big winners are and where they are. And I keep saying this, the market's too many stocks to actually pay attention to all of them. So concentrate your research on the area that's going to find or produce the best results. Maybe even a super stock, because the traits we're looking for pretty much. These super stocks have fit them. That's 1,000% more 10 bagger pretty much. And this is basically set up, the MicroCap League, to find these kind of businesses, and they're scored and color coded to try and find these businesses, try and wheel them out. Ask yourself these 3 questions to cover off the 3 most important aspects of investing. This is what I do. I mean, you can follow this, of course, but you don't have to. Everyone has to find their own way. But what, when, how, and I sort of highlight this in the book. And what is fundamental analysis, looking at the financials and so that. Does the company possess growth and value? Those are 2 most important metrics for growth stocks. Growth is the most important, value is second most important, and they are scored accordingly, the highest scoring metrics on the website, okay? And also, is it a performer or a recovery play? If it's a performer, it should possess growth and value. It's already there. It could have been a previous recovery play, but now it's performing, An example, so Time Finance, pretty much everything, top line growth of 15%. It would be in the green if I had 20%. But nevertheless, every other metric pretty much is green, almost top scores in both. Also, Synectics, again, almost all green on the growth and the value. So they are performers, If it's a recovery, it should possess value. It can't be overvalued, pretty much. And it's gone through a period where it's had a bad patch and still be overvalued. It should be good value, even brilliant value, if it's going to recover. But of course, if it's not going to recover, it becomes even more compelling value because it's not doing well. And if it's a recovery play, how confident are you the growth will return? Because if it doesn't, it's not going to recover. Full stop. So hope that makes sense. Performer has both, recovery play has good value, but hopefully growth will return. And then if it does return, it'll be excellent value because generally, after a company's issued a couple of profit warnings, they'll be oversold massively. And if they're regaining their previous growth, it should kick back up. Example of this, by the way, is ADF. And this is a typical example, facilities by ADF, where I think people are looking in the rearview mirror when investing here. They supply all the sort of trailers to the TV and film industry in the UK. Their clients are like everyone from BBC to Netflix to Amazon. I think they're one of the biggest suppliers in the UK. There are trailer count to over 700 by the end of 2023. That was. Now it doesn't look like compelling here, but that's after. This is based on these results, which were bad for them because the writer's strike, of course, slowed down all productions, and that ended in November. So of course it affected last year. That's last year's results. Now, if you look what they said in their statement about H1 this year, it's going to be significantly ahead of H1 last year. And you scroll down, and the value's fine because the value is based on those last results. So this is what you need to look at. Stocks are also about what's going to happen, not what happens. So sometimes you can get a bit of an opportunity because they'll release their final results and they won't be very good and the stock will go down. But they've already said that business is improving, operations improving, growth is happening. And that's what's happened here. And yet it's starting to rally. And in fact, what's the momentum here? Because now, if you look at this, if you look at the going forward, so if you look at my forecasts, you can see for 2024, they're expecting 10% growth, even with that bad year. But for 2024, they're expected to do 35%, up to 47 million. And look at the improvement in the EBITDA, 69%. And 15%, or even if you've got a profit, of post-tax profit, 5 million, 50% gain. And so look at that. And the valuation here is very good going forward. If they hit the forecasts, there's always an if. I said, forecasts are always about looking into the future. But I can safely say that they were hit by something outside their control. It wasn't company specific. That's now been remedied. And so this could be a very good recovery play. And the most important thing of all, I say, focus on risk. And it's in a bull market, people only focus on reward, and when the bear market comes in, you're in trouble sometimes. But if you focus on risk first, not reward, you tend to be a bit more focused on what you're doing. You think about it really, because there's no reward at the start, it's risk. Think, how much can I lose? Most investors lose money because they focus on reward too much. That means they go too big on their initial investment, and the losses start getting bigger. And some people even average down. In a bull market, it's not so bad. In a bear market, all it does is leverage your portfolio towards your losers rather than your winners. You keep chucking, good money after bad, and it doesn't help. It doesn't work out because there's no guarantee. There's no guarantee a stock price will turn around. You may think it is in your head, but you want it to. You hope it will because you've got lots of money in there. There's no guarantee of that. So it makes sense to limit the downside. Don't limit the upside, because I said companies can go on and do multiples and multiples, especially microcaps. So I've seen people do. That's another thing. Private investors get wrong. Well, I've done that, taking a profit too early and holding on to their losses. Now you add those two together, and you've got a portfolio guaranteed to be leveraged towards your losers rather than your winners. So take the loss early, don't take the win early.